Good afternoon, everyone. Welcome to today's session on the IMF WEO chapter, Shifting Gears, Monetary Policy Spillovers During the Recovery from COVID-19. Before we begin with the official opening ceremony, we will do a small administrative briefing. So the recording of the seminar will be for internal IMF purpose only. It is an off-record conversation, and the recording will not be used publicly. The rules of online interpretation through the Zoom platform. If you want to make use of the interpretation channel, please look for the sign of the interpretation icon on the bottom of your screen. So if you are a French speaker, you choose the French channel. And if you're a Portuguese speaker, likewise, you choose the Portuguese channel. Make sure you mute the original audio. Likewise, if you're using an iPad or an iPhone, look for the three dotted lines, and then you choose your interpretation language. Again, if you're a French speaker or a Portuguese speaker, you choose the channel of your preference, and make sure you mute your original audio, and click on Done when you're finished. So I present to you the ATI administrative team, Mr. Kananguli, who is the chief of the administration, Mr. Kirby Armugom, senior IT administrator, Mr. Steve Raquin, IT technician, and myself, Anna, the training center assistant. And sharing with you the interpretation team. So on the French team, we have Mr. Olivier Fléché, Mr. Rajan Somi, Mr. Dagmawi Astrat, and on the Portuguese team, we have Manuel de Freitas and Maria Texiera. So in order to interact effectively in a virtual environment, we'll kindly ask you to mute your microphone when you are not speaking. And for participants, please use the Q&A for question. Keep the question concise. Some question will be submitted to the speakers. And for information, only the video of the panelist will be on. So please follow us on social media for information. This webinar is being streamed live, and we will send you the link shortly. And follow us on Facebook and Twitter as well. So I thank you for your attention, and I will now leave the floor to the ATI Deputy Director, Mr. Carlos de Rezende, who is going to do the official ceremony. Over to you, Mr. Carlos. Thank you. Sorry, Carlos, you are muted, I think, Mr. Carlos.
Sorry. Can you hear me now?
Yes.
Thank you, Anna. Thanks a lot. It's a pleasure to have you all with us today for this webinar on one chapter of the last WEO report. The World Economic Outlook report that was released in the spring. With us today, we have economists Galen Scher from the research department at the IMF and Ken Sever from the African department. Galen will present the chapter. And then we're going to have some discussions, some points for discussion by Ken Sever. Without further ado, let me introduce you the presenters today. So we have with us, as I said, Galen Scher, my colleague from the Department of Research, from the Research Department at the IMF. He works in the Multilateral Surveillance Division, and he also had previously worked in other IMF departments, like the Western Hemisphere and the Monetary and Capital Markets departments. And previously, he also worked as a research economist at the Bank of England. His research focused on applied econometrics and risk measurement. We also have with us Ken Sever, who's also an economist at the IMF. He's currently at the African department and previously worked for the Monetary and Capital Markets Department. Can has contributed to various publications at the IMF, like the GFS report, the Global Financial Stability Report, the GFSR, the Asia Pacific Regional Economic Outlook, the RIO, and also the World Bank Global Financial Development Report, GFDR. His research interests cover international finance and macroeconomics and political economy. He has a PhD. He holds a PhD in economics from the University of Maryland, College Park. So it's my absolute pleasure to have you with us, Galen and Ken, and the floor is yours. Thank you very much.
Well, good morning. Good afternoon to everybody. Thank you so much for joining. I'm really looking forward to this session. I'm quickly sharing my screen. All right, I hope you can see it now. Thank you so much to the Africa Training Institute for hosting this session, for all the work in organizing this session. It looks like we have a lot of people participating, and I'm really looking forward to discussing this with you today. I will share with you some results from our analysis of monetary policy spillovers, which was published in April in the World Economic Outlook. I have about 18 slides to get through, and then we'll have a discussion. Thank you very much to Jan for agreeing to discuss this work, and then we'll open up for Q&As. This is a joint project. Many people contributed to this project. I'm getting the credit by presenting to you today, but really there was a big team behind it. So I want to thank my co-authors, especially Philip Engler and Roberto Piazza, on this chapter. And we received a lot of support from other people who are also named on the slides. But of course, the authors of the project retain any responsibility for any errors in the work. So this work is about monetary policy spillovers. And let me start with some motivation for this work. Part of the motivation, clearly, to look at monetary policy spillovers is what happened this year in financial markets. We saw in the beginning of this year that interest rates rose around the world quite dramatically, especially in the United States, on the back of fiscal stimulus and rapid progress on vaccinations. And at the time of rising interest rates in advanced economies, interest rates in emerging markets rose quickly as well, in parallel. Also in February and March of this year, capital flows started leaving emerging markets, reaching a peak of $1 billion a day in portfolio capital outflows. And these were obviously very worrying times. And many economists were worried that we might see a taper tantrum, the likes of which we saw in 2013. Thankfully, interest rates stabilized from April onwards. And similarly, capital flow started coming back to emerging markets from April onwards. So we seem to have avoided the worst case scenario. But nevertheless, this shows you the fragility of the recovery at this point in time, and the kinds of imbalances that can happen in a two-speed recovery, where some economies are recovering while others are still dealing with the pandemic. So worries of a taper tantrum were one motivation for this chapter. But another motivation for this chapter is what happened during the pandemic itself. So during the pandemic, financial conditions in emerging markets tightened dramatically. And then around March 23rd, credit spreads in emerging markets started to come down again. So one question is, how much of this is due to the massive monetary policy accommodation undertaken by major advanced economy central banks at this time? And how much of it is due to monetary easing in emerging markets themselves at this time? Because we know that emerging markets were able to cut their interest rates significantly during the pandemic to support their economies, and many launched asset purchase programs for the first time. So many economists were quite surprised by this at the time. They thought that emerging markets would be constrained in how much they could ease monetary policy during the pandemic because of this massive capital outflows that we were seeing at the time and the rise in credit spreads at the time. So this suggests that emerging markets may have obtained more autonomy from global financial conditions than before. So all of these are motivations for the chapter, and we can summarize what we analyzed in the chapter with these two main questions. On the left, we look at measuring how large are these spillovers from the United States and the euro area to emerging markets. And specifically within this question, we tried to distinguish between the spillovers from monetary policy surprises and the spillovers from news about the US economy or news about vaccines in 2020. That's one question. In order to analyze that particular question, we used an event study analysis approach. We took 2 decades of data on emerging markets. We conducted some panel regressions. We used the days of announcement of Federal Reserve or ECB monetary policy decisions. And we used the days of announcement of economic news in the US, like employment news or inflation news in the US. And we looked at what happens in emerging markets on those announcement days. I should clarify that to measure a monetary policy surprise, we used 2-year government bond yields in the US and in the euro area. We used changes in these yields in a short window around the monetary policy announcement itself to measure the monetary policy surprise. And this is following several recent papers in the literature. It allows us, it has several advantages, this way of doing it. But there are other ways of doing it as well. So that's one question. How large are the spillovers? Now, the other question that we look at in the third part of this chapter is which emerging and developing economies were able to provide more monetary policy support during the pandemic. So which economies were more likely to launch asset purchase programs during the pandemic? And which economies were able to cut their policy rates by more during the pandemic? And to analyze this particular question, we used several cross-section analyses, simple cross-section analyses. We modeled the probability of launching an asset purchase program with a logistic regression. And we measure the factors that were more conducive to cutting policy rates using linear regressions. So I should mention that in our event study analysis, we have 2 decades of data. We cover 60 emerging markets. About 10 of them are in Africa. We also have a small analysis of low-income countries as well. And I don't have a slide on that, but I do plan to cover it. So please remind me if I forget to mention we have a small analysis on low-income countries. I might also show you a slide on swap lines. So the rest of my presentation will be structured into 3 parts, and I will go over the results. First, for monetary policy surprises. Second, for economic news spillovers and vaccine spillovers. And thirdly, looking across emerging and developing economies and seeing which are the factors that helped economies, helped central banks support their economies by more during the pandemic. So turning to monetary policy spillovers first. We find that monetary policy spillovers are quite large. So on the top left chart, we're showing you what happens to interest rates in emerging markets when the Federal Reserve and the ECB hike interest rates. These are monetary policy surprises, so they were not expected before the event. We find that when the Federal Reserve increases its policy rate by 100 basis points, this tends to translate into about a 33 basis point increase in long-term interest rates, long-term government bond yields in emerging markets. So this is a pass-through from US interest rates to emerging market interest rates of about 1/3. So this is a significant effect. Now, the blue bars are showing you the spillovers from ECB, European Central Bank, monetary policy decisions, and these tend to be about 40 to 60% smaller than the spillovers from the Federal Reserve. These are effects on the average emerging market. We found that for the spillovers from the ECB, they were much stronger to some economies than others. In particular, economies that are more integrated with the Eurozone, that have more trade with the Eurozone, like Eastern European countries. Those countries experience much stronger effects of ECB monetary policy surprises. So this is why we say in the chapter that spillovers from ECB monetary policy actions are more regional and spillovers from Federal Reserve monetary policy actions are more global. And using the estimates from the top chart, we can do a back of the envelope calculation. We can ask ourselves, how much higher would interest rates have been in emerging markets if not for the massive monetary policy accommodation by advanced countries? And if you do this simple calculation using our estimates, you find that interest rates in emerging markets would be at least 1 percentage point higher if not for the massive monetary policy accommodation by the Federal Reserve alone. We say that this is a lower bound on the size of the effect. The effect is probably even larger because this back of the envelope calculation cannot capture what would have happened if the Federal Reserve had not eased at this important moment. We could have had significant distress in many economies and a much deeper crisis. So on the chart, on the lower chart, you can also see that there's a gray shaded area that's quite large. Now, this is telling you that most of the spillover effect from the US to emerging markets is working through a term premium component. So if we split up emerging market interest rates into expected future policy rates and a residual term premium component, then most of the effect goes through the term premium component. Now, what is the term premium? It's a risk premium. It's an extra return that investors receive for holding long-term government bonds, and these come with liquidity risks, inflation risks, monetary policy uncertainty. And so the term premium is a risk premium. So most of the effect seems to go through the term premium rather than expected policy rates. We can take a look at this another way. On the next slide, I show you the spillovers from US monetary policy actions on financial conditions in emerging markets. And now I'm showing you not just the effects on interest rates, but also the effects on stock markets, exchange rates, portfolio flows, etc. And the important thing to note here is you can clearly see how big the effect is on the term premium in emerging markets. There is also some effect on monetary policy, expected monetary policy actions in emerging markets. So it seems that emerging markets do tend to follow the Fed a little bit. At least this is what markets expect based on market prices. But that effect is quite small. Most of the effect on interest rates goes to the term premium. Now, very importantly, portfolio flows leave emerging markets when the Federal Reserve hikes monetary policy. And we see some depreciation in exchange rates in emerging markets. So for all these reasons, we say that the effects of a monetary policy surprise can be harmful on emerging markets because they tend to tighten financial conditions. And we can look at the effect on the term premium was an effect on a risk premium. So that led us to wonder, are the effects stronger to riskier economies, or is there a risk channel by which US monetary policy is transmitted across borders? And indeed, you do find that riskier economies, as measured by whether they have a speculative grade credit rating, whether they have a high share of debt held by non-residents, or whether they have volatile currencies, these economies do experience stronger spillovers from US monetary policy actions. So this suggests that the effects, the international effects of US monetary policy seem to work through changes in global investors' risk perceptions or risk aversion. We also looked, several economists have noted that spillovers from the United States have been increasing over time. And that's what the bar chart on the bottom is exploring. We looked at that and found that most of the spillovers have been increasing over time, indeed, but most of that seems to have happened between 2008 and 2013. So most of it happened during the global financial crisis and the Eurozone debt crisis. So this trend of higher spillovers over time seems like it has to do with this crisis period and not so much related to other potential explanations, long-term structural explanations like rising trade and financial integration. Now on swap lines, on March 19th, the Federal Reserve announced US dollar swap lines with 9 other central banks. 2 of those central banks were emerging markets, Brazil and Mexico. So we can look at what happened in Brazil and Mexico on the day of this announcement and look at what happened in other emerging markets on the day of this announcement, those emerging markets that did not receive the swap line, and compare what happened to get a sense of the effect of the swap line announcement. And indeed, you find that the swap lines seem to help. The Brazilian and Mexican currencies appreciated the day after the announcement, even as the currencies of other emerging markets were depreciating. And credit spreads in Brazil and Mexico declined, even as those credit spreads were rising in other emerging markets at the time. So this suggests that swap lines seem to ease financial conditions when they were announced. And now I will turn to the spillovers from economic news and from vaccine news. So within economic news, we look at 2 types of economic news. One is news about US employment, and the other is news about US inflation. And to measure the surprise, the US employment surprise, we look at market surveys the week before the announcement, and then we look at the announcement itself, and we just take the difference between the two. So whatever the jobs number was, compared to what people expected the jobs number to be before the announcement. So that gives us a measure of the surprise, the economic news surprise. So again, a similar style chart, the effects of US employment surprises, they tend to lift interest rates in the United States, and they lift local currency government bond yields in emerging markets as well. Now, on the surface, that looks very similar to a monetary policy surprise. But what's different with an employment surprise is that credits with the good news about US employment, credit spreads in emerging markets come down and portfolio capital flows into emerging markets. We also see that the VIX, the volatility index in the US, declines as well. So for this reason, we say that positive news about US employment tends to be benign for emerging markets. On inflation spillovers, we found very little spillover from inflation surprises in the US. Of course, inflation in the US tends to lift interest rates in the US, but there seem to be very little spillover to emerging markets from inflation surprises. And that could be because inflation surprises in the past have reflected a combination of cost push shocks and demand pull shocks. So expansionary and contractionary forces can both give rise to an inflation surprise. So turning to spillovers from vaccines, how do we measure these spillovers from a vaccine? We look at stock prices of BioNTech and Moderna. We remove the component of the stock return that is correlated with a portfolio of US healthcare stocks. And then we look at extreme movements in this residual index. And these are the days that we identify as being days with important news about vaccines in the US. And we find that positive vaccine news, similar to employment news, positive vaccine news also tends to lower credit spreads in emerging markets and increase portfolio flows into emerging markets. Stock prices go up in emerging markets, and the volatility index comes down in the United States. So the spillovers from vaccine news are also benign for emerging markets, even though they're lifting interest rates in the United States. So all of these results together are painting a picture where rising interest rates in the US can have different effects on emerging markets depending on what's causing the rise in US interest rates. If it's good economic news, the effects on emerging markets are quite benign. If it's monetary policy news, those effects can be harmful for emerging markets. So really the interpretation of the rise in US interest rates is very important. And now to turn to the third section of my presentation, the last part of my presentation, which is about analyzing which emerging and developing economies were able to support their economies by more during the pandemic through monetary policy actions. So we start off by looking at which are the factors that made launching an asset purchase program more likely. And we found, of course, that flexible exchange rates, economies with flexible exchange rates were more likely to launch asset purchase programs. That's not surprising because flexible exchange rates give you more monetary policy autonomy. But interestingly, we found that inflation targeting countries and countries with more fiscal rules were more likely to launch asset purchase programs. So this suggests that more rules-based monetary and fiscal frameworks helped in supporting economies during the pandemic. Central bank transparency also played a role. More transparent central banks were also more likely to launch asset purchase programs. Then we found that policy choices mattered as well. Foreign exchange intervention tend to be used together with asset purchase programs. So they weren't substitutes for each other. They were used together a lot of the time because both of these tools were used to fight dysfunction in markets. There were also fiscal conditions that made it more likely for emerging markets to launch asset purchase programs. So we found that fiscal space is very important. Now, it's really the countries with intermediate levels of fiscal space that were more likely to launch asset purchase programs. So countries with a lot of fiscal space or very little fiscal space were less likely to launch asset purchase programs, probably because they either didn't need the asset purchase program or they didn't want to launch the asset purchase program. So it was really the countries in the middle with intermediate fiscal space that were most likely to launch asset purchase programs. And an investment grade credit rating helped as well to launch an asset purchase program. We found that the deterioration in the fiscal balance was not a good predictor of whether countries launched an asset purchase program. And we interpret that as saying that for the most part, asset purchase programs weren't used for debt financing. Although we know, of course, in some countries, they were explicitly explained in that way. But on average, in most emerging and developing economies, they weren't used for debt financing. Now we look at the determinants of policy rate cuts during the pandemic, and we found that they're very similar to the determinants of asset purchase programs. Again, you see flexible exchange rates. Countries with flexible exchange rates were able to cut their policy rates by more during the pandemic. Countries with inflation targeting regimes and fiscal rules were able to cut their policy rates by more. And countries with with more transparent central banks were able to cut their policy rates by more as well during the pandemic. So let me wrap up with a quick discussion of what this means for policy looking ahead. So clearly, the rise in US interest rates this year has reflected a combination of factors. But on balance, so far, it seems that good economic news has been the main driver of higher US interest rates. The outlook has improved this year globally, but risks remain elevated. Interest rates in advanced economies have significant room to rise. And if they rise rapidly, it could tighten financial conditions and hold back the recovery. Therefore, we have called for major advanced economy central banks to provide further guidance about their likely policy responses under different economic scenarios. So far, the Fed has communicated very well under tough conditions. While it has provided clear guidance about policy rates, market participants remain uncertain about the likely future path of asset purchases, and this uncertainty arguably contributed to elevated term premiums around the world. And given risks to the outlook, emerging markets should maintain monetary policy support and borrower support measures as much as possible. Of course, the ability to do so depends on some autonomy from external financial conditions, and the results in this chapter suggest that credible communications and fiscal and monetary frameworks can help preserve autonomy. And now's the time to reduce vulnerabilities and build buffers. Emerging markets can lock in currently low interest rates, hedge their currency exposures, and see whether they need a plan to accumulate reserves. And multilateral cooperation remains essential. Our chapter shows that the swap lines extended to Brazil and Mexico last year helped to ease their financial conditions. SDR allocations and precautionary fund facilities can also provide significant buffers. The G20 debt service suspension initiative was usefully extended to December of this year, and the common framework for debt treatments is welcome and could be extended to more countries. Thank you for your attention.
Thank you very much, Galen. We are receiving some questions on the chat and on the Q&A's section. I will save some of those for the end, if you don't mind. I will prefer to have Jan presenting his discussion now, and then we proceed with the Q&As. The floor is yours, Jan.
Thank you. And thank you for organizing this event. And also thank you for the great presentation and very interesting chapter. So, I mean, the chapter is very comprehensive and extremely timely given the recent developments across the globe. And it provides insights for coming months and years of recovery from the pandemic. Before I start, let me make it clear that the usual IMF disclaimer applies for this discussion. Before going into spillovers, I will start with domestic policy responses to the COVID-19 pandemic by emerging market central banks. The pandemic has hit many emerging markets hard during last year. Many of them saw economic downturns, tighter financial conditions, and severe capital outflows. But domestic central banks acted swiftly and decisively, which helped emerging markets during the heights of the pandemic. Many emerging market central banks cut interest rates, as you see in this figure, and in some cases to historical lows. And the situation was similar in AFR countries. Many central banks had synchronized interest rate cuts. However, emerging market central banks use other available tools as well on top of interest rate cuts. If you look at this figure, the first bar shows like more than 90% of emerging market central banks cut policy rates. But if you look at the second bar, for example, you'll see that more than 60% of emerging market economies, including sub-Saharan African countries, used FX interventions. And for the first time, government bond purchase programs or asset purchase programs. So unconventional monetary policy measures were also implemented by many economies, including some African countries. And we have evidence that these domestic policy responses by EM central banks were effective during the pandemic. However, this was not the end of the story, as the chapter discusses. As analyzed by the chapter, monetary policy decisions by advanced economies play a crucial role in the financial markets of emerging market economies, and such spillovers will remain important going forward. The chapter argues that monetary policy decisions or monetary policy easing by advanced economies during the current pandemic eased financial conditions in emerging market economies. And this is also supported by other recent findings within the IMF. And going forward, the chapter argues that monetary policy, as discussed by IMF World Economic Outlook reports since the beginning of the pandemic, the recovery is likely to be uneven. And the chapter discusses that this would pose challenges for emerging market central banks. And the recovery, I said, is likely to be uneven as discussed by the IMF because the extent of the scarring is likely to be different across advanced economies and emerging market economies. Fiscal support was much stronger in many advanced economies due to higher available fiscal space. And uncertainty about the containment of the COVID-19 cases, mainly due to vaccine rollout, is different in emerging market economies. Relatedly, the chapter finds evidence that spillovers from the US is very important for emerging market financial markets. A tightening in the US resulting from a stronger US economy does not have much effect on emerging market economies. However, a surprise tightening in the US triggers increase in yields, capital outflows, and also currency depreciation in emerging market economies. However, on the positive side, the chapter argues that domestic policy responses can shield emerging market economies from such adverse financial spillovers. Emerging markets can insulate themselves by adopting more transparent and rules-based monetary and fiscal frameworks. The chapter also finds that existing conditions can affect the extent of the strength of domestic response by emerging market central banks to those spillovers. For example, domestic monetary and fiscal frameworks can help predict the extent of monetary policy accommodation in emerging markets. In particular, countries with more flexible exchange rates, more transparent central banks, and more rules-based fiscal and monetary policy frameworks cut policy rates by higher amounts. And also these countries were more likely to announce an asset purchase program. The chapter also finds that more constrained fiscal space can lead to a smaller likelihood of an asset purchase program. And also there's evidence that existing domestic risks play a role in determining the size of spillovers. For example, like speculative grade credit, high external debt share, or high currency volatility can amplify spillovers from advanced economic monetary policy decisions to emerging markets. But this also means there's a room for domestic policies during recovery. For example, like speculative grade credit or high external debt share, as well as high currency volatility, are directly related to reserve and debt management policies. For example, like the recent or the new SDR allocation by the IMF would be very important for African countries, and it would be large compared to GDP or existing level of reserves. And also, for example, improving domestic investor base would help to decrease high external debt share in some countries. I mean, the chapter is comprehensive. As I said, they look at several factors, but I think there are some other factors which can be important through risk channel in terms of amplifying the extent of spillovers and also increasing the capacity of domestic central banks to react to those spillovers. And I would like to hear like opinions of Galen on these factors. And some of these are more relevant for African countries. First, institutional factors can increase country risks, such as institutional quality or governance practices. Political risk and uncertainty would also be important, and we also have evidence that after pandemics, the likelihood of social unrest is increasing in general, so this can be important for some countries. Financial market deepening and financial inclusion would be important, both for the capacity of central banks to react and also effectiveness of monetary policy by promoting the transmission channel. Financial soundness is another factor because it is likely that the pandemic would have scarring effects on bank balance sheets in terms of non-performing loans or asset and credit quality. The authors look at central bank transparency, but central bank independence, a slightly different concept, may also be important for these factors because especially in the case of large and open-ended asset purchase programs, there may be concerns about fiscal dominance, which would decrease effectiveness of those policies for emerging markets. So central bank independence, I mean, asset purchase programs pose a challenge for central bank independence as well. And other fundamentals can also be important, such as, for example, the authors look at currency volatility. So level of reserves would be an important factor determining that, and also current account balance would affect the vulnerability of these countries to capital outflow pressures. Second, Galen said that they have a nice section about low-income economies, but I would like to hear more about that. They say that the spillovers from advanced economies to lower-income emerging market economies is lower in general. So I would like to hear like what can be the channel. And they also mention some African countries in their report. For example, they say that vaccine news or ECB monetary policy surprises are important for several African countries. And I would like to ask what they think about some African countries. They peg their currency to euro, for example, West African countries like WAMU countries. And also some African countries like Benin and South Africa are issuing euro-dominated government bonds. So I would like to hear what they think, like what can be the effect of ECB on those countries specifically. Having said this, let me look at recent developments, especially after the chapter is written. In advanced economies, we are seeing a rapid vaccination. For example, in the US, as of now, more than 40% of population is fully vaccinated, which also means like decreasing number of cases in several advanced economies. The strong fiscal support is still going on in several advanced economies, including the recent stimulus in the US, which may help recovery in these countries. And also April inflation numbers in US were higher than expected. So it was a positive surprise. I mean, it was a surprise in that sense. So like it can affect monetary policy decisions in coming months and years. All these point to a reversal of interest rate cuts during the pandemic as advanced economies recover. On the emerging market side, the pandemic is far from being contained in many emerging market economies, especially due to lower vaccine rollout compared to advanced economies. And fiscal space in the post-pandemic world is now much limited in emerging market economies, as well as monetary policy space, especially with new inflation pressures. So we see in many emerging market economies, inflation is increasing, and increasing commodity and food prices are a contributing factor to these inflationary pressures. Some emerging market economies like Brazil and Turkey already reversed interest rate cuts. And there are also existing vulnerabilities, and these should be evaluated case by case. Some of them are related to African countries more. For example, currency volatility is an issue and maybe an issue given the lack of reserves in some countries. But as I said, like the new SDR allocation plays a role here. And also vulnerability to capital outflows. For example, the current account balance would be important for some countries. Financial markets, so shallower financial markets and the scaring effect of the COVID-19 on financial institutions' balance sheets would be important. High public and private debt and also external debt is a risk for some countries. And also, as I said, like political risks and uncertainty together with social unrest risks would be important for some countries. And when we look at these pictures, this divergence between advanced economies and emerging market economies, this points to a multi-speed recovery, which may lead to an asynchronous withdrawal of monetary policy. As the chapter finds, an unexpected sign of higher future US interest rates can lead to tighter financial conditions in EMs. On the other side, as again the chapter discusses, a gradual normalization of US interest rates driven by positive US news, positive US economic news, is likely to be manageable for many emerging market economies. However, as I said, like emerging market economies shouldn't take this as granted because like there are countries with fiscal and external vulnerabilities, and also some countries has a lack of trade ties to US, which can benefit less from the trade channel from a growing US economy. And also, as I said, there are country-specific risks like public debt, private debt, concerns about fiscal dominance, which is related to central bank independence as well, inflationary pressures, level of reserves, financial market risks, and political risks are important for some emerging market countries, including the FR countries. Thank you.
Thank you, Jan. Thank you very much for this insightful discussion. Before we go to the Q&As, I would maybe give Galen the chance to respond to some of these points that Jan just made, and then we can open the floor for questions.
Yes,
Galen, please.
sure. Thanks. Thank you very much, Jan, for this rich discussion. Thank you for reminding me as well about the section we have on the spillovers to low-income countries. So we do see spillovers from US monetary policy actions to exchange rates in low-income countries. So low-income country exchange rates depreciate against the US dollar when the US tightens its monetary policy. And interestingly, the size of this effect is quite similar to the spillover that we saw to emerging market economies. So low-income countries and emerging markets both have similar exchange rate effects when the US tightens its monetary policy. But we see limited spillovers to interest rates in low-income countries. The only effect we found was some spillover from ECB actions to short-term interest rates in the average low-income country. Vaccine news, we found that positive vaccine news tended to lift long-term interest rates in low-income countries. So we see this as a demand effect, probably an external demand effect. So those are the results we have for the spillovers to low-income countries. And then I'd like to offer a few thoughts on some of the suggestions you had. Definitely, you mentioned a number of other ways in which countries are different, a number of other ways in which spillovers might be stronger to some economies than to other economies. Most of these points, I think, are valid, and some of them we didn't investigate just due to time constraints. But I can comment on a few of the points, the ideas you had. So the risk channel, first of all, we document in the chapter that there's a risk channel, that riskier economies seem to be more affected by US monetary policy. Now, this risk channel has been noted for many years by economists, so we're not the first people to mention this. But I should note that there are plenty of exceptions and caveats to this finding of this risk channel. And so there's a lot of ongoing research still trying to understand the risk channel more fully. For example, measures of external risk tend to do a better job than measures of domestic fiscal vulnerability. So it's not all measures of risk that are important, but really it's measures of external risk that seem to be the most important. So one possibility, as you note, is to use reserves as a measure of risk. Maybe countries with more reserves are safer, and therefore maybe they would experience less of a spillover. So we did analyze reserves, and we didn't find much difference between countries with higher reserves and countries with low reserves. And so we didn't report on that in the chapter to save space. But one possible explanation is that, of course, reserves are a choice, and an economy with lots of vulnerabilities will feel a greater need to hold reserves. So reserves, because they're a choice, they may not be a great measure of risk themselves. So current accounts is another important measure of risk that some people use, and it's a measure of external risk. Now, we did find that exchange rates do react more to US monetary policy surprises in high deficit countries. But we didn't find any difference in interest rate movements between high deficit and low deficit countries. So it seems that current account balances seem to affect the nature of the spillover. So they seem to affect how much of the spillover goes through interest rates versus how much transmits through exchange rates. So it's quite a nuanced result we had for current accounts. For financial market development, we looked at whether countries with more developed financial markets, maybe they are more insulated from global financial conditions, or maybe they're less insulated because they're more integrated. So we looked at that, and we found that financial market development does tend to insulate interest rates from US monetary policy. But the effects were not statistically significant, so we couldn't really say much. So then you have a very interesting point about what are the spillover effects for WAEMU countries, for example. So I think there are two things going on here that we need to separate. The one is the role of trade integration. So we found that countries that were more integrated to the euro area experienced stronger spillovers from the ECB. So some African countries are more integrated than others with the eurozone. So they should be expected to experience stronger spillovers from the ECB. The second question is about pegs and floats. So whether the exchange rate regime affects the degree of spillover. And we spent a lot of time on this question and found that there was not a lot of difference in the spillovers between fixed and floating exchange rate regime countries. We looked at different ways of measuring the exchange rate regime, whether it's based on the laws of the country, so a de facto measure, a de jure measure, or whether it's based on exchange rate flexibility and movements in reserves and interventions, which is more of a de facto measure. There seemed to be consensus amongst all the different measures that there wasn't a lot of difference in the spillover between fixed and floating regime countries. Now, we wouldn't go so far as to say that there's no insulation that comes from a flexible exchange rate regime. Indeed, we saw in the third part of the chapter that countries with flexible exchange rates were able to cut policy rates by more and were more likely to launch asset purchase programs. But it did lead us to have more questions than answers. And we comment that future research needs to look at this in more detail. And in particular, researchers out there need to reconcile the findings that we're finding with earlier work, which found important insulation properties from flexible exchange rates. So there's a recent paper by Giancarlo Corsetti and other co-authors showing that flexible exchange rates in Europe don't seem to insulate economies from spillovers from the Eurozone, and they call it an exchange rate insulation puzzle. So what we were finding for US spillovers is consistent with what other academics are finding for Euro area spillovers. So definitely an active area of research. More research is needed. So you ask why the spillovers are lower to low-income countries. Of course, the spillovers to exchange rates were the same, but the spillovers to interest rates were lower in low-income countries. Now, this is a really good question, and we didn't offer an explanation in the chapter. We tried to, and we ended up cutting it. But there are several possibilities. One is that low-income countries might be less economically integrated with the euro area. I would say that would be the leading explanation. But another explanation is that the transmission from the euro area to low-income countries might take longer, perhaps due to illiquidity. And this is a measurement issue. So maybe that's why we didn't find it. There also may be capital controls in low-income countries that insulate them from spillovers to some extent. And the capital controls may also allow monetary policy in these countries to be more counter-cyclical than in other places. So there's two dimensions to that. So there are all these possible explanations, but we didn't want to take a guess in the chapter, so we didn't write them down. But thanks again for this really good discussion. I was only able to respond to some of your points, but thank you very much.
Thank you a lot for your responses.
Thank you, Galen. So yes, you touched on a few questions that we got, and then there were a few questions about African economies, and you touched on one important aspect, which is how economies in monetary unions or with fixed exchange rates would react relative to the typical economy in your analysis. Now, just one clarifying question. This is from me, but I think that it captures some of the questions that have been asked also, which is the following. So one main takeaway from your analysis is that if monetary policies tightens in response to, let's say, good economic news, as we expect, let's say, in a standard New Keynesian framework where, with a Taylor rule, the interest rate is supposed to react to expected economic good economic news, then the spillovers to emerging economies is more benign in general. But if there are unexpected or unanticipated monetary policy tightening, then should I interpret this as tightening that goes above and beyond what we would expect from a reaction function, normal reaction function of the central bank? And then in that case, we should expect less benign outcome for emerging and low-income countries. If that is the case, I wonder if you could elaborate a little bit on the channels, on the transmission channels. There are a few questions regarding the transmission channels. So why monetary policy tightening that is expected in a way has a benign outcome, and what are the transmission channels for that? Would be trade, for example? I mean, I'm just thinking out loud.
Okay, so I can respond to each question in turn, or we can collect questions and I can respond to it. So as you prefer, whatever is easier.
We can start with that one, and then I have more here from
Yes.
participants, and then we can go.
Okay. Thank you very much. Great question. Definitely, I meant to discuss this also in my presentation, so thanks very much for bringing that up. So transmission channels, yes. Firstly, how do we interpret the monetary policy surprise? Indeed, it's a change in the interest rate that was due to the monetary policy announcement that was not expected just before the announcement. So it's something that market participants did not expect. So you can have a monetary policy easing and it can still be a tightening surprise. In theory, it's possible to have these kinds of things. So yes, it's a deviation from the reaction function. This is also an active area of research. There are people discussing whether it's a trembling hand by the Federal Reserve, so a deviation from their previous reaction function, or whether the central bank has more information on economic conditions than the rest of the economy, than the rest of the market, and therefore whether it's not a deviation from their reaction function. It's just that they're reacting consistently with how they've always reacted, but they have more information than everybody else. So it's revealing information about the state of the economy. That's why in 1/3, I think it's about 1/3, I don't know the exact number, I think it's 1/3 of announcements, the US stock market goes up when the Federal Reserve tightens monetary policy. So there's an active research agenda into whether the Federal Reserve is revealing information about the state of the economy in its decisions. So yes, I agree that the interpretation of a monetary policy surprise is a little bit cloudy at this point, and more work is still needed. But for the most part, we think of it as a deviation from the reaction function. So a tightening that was unexpected. Now, what are the transmission channels from US economic news to emerging markets? In the chapter, we talk about a trade channel as being a leading candidate explanation. And indeed, we find that exchange rates, so emerging market exchange rates depreciate when there's a positive news, positive economic news in the US. And we found that the depreciation is stronger in countries that are more trade integrated with the US. So it indeed seems to be some validity behind this trade channel, but the evidence was not very strong. Actually, a more plausible channel, which I think we're the first people to identify this, is that positive economic news in the US seems to lower risk. It seems to lower risk perceptions and risk aversion. And we see effects on the VIX, on term premia, on credit spreads, etc. And riskier EMs tend to be more affected by positive economic news in the US. So actually, a stronger explanation than trade channel seems to be some kind of risk channel, even for the economic news as well.
Thank you. Thank you. Let me ask a question now on policy. I think that both you and Jan touched on some of these issues, and so the question can be for both of you. It's from a colleague from Madagascar, and who is asking, what is your advice, I guess, about the optimal coordination of fiscal and monetary policy during the recovery post-COVID-19 for poor countries like Madagascar, or low-income countries, I guess, and others in Africa, to avoid, or to mitigate some of these harmful potential spillovers from the eventual tightening of monetary policy in the US, I suppose.
Yeah, I can start and then Jan can complement. So fiscal policy at this point, fiscal policy needs to be focused on saving lives and livelihoods still. And Africa especially is struggling with the consequences of the pandemic. and this is expected to be around for a while still. So the important thing is to the extent possible, now of course governments are fiscally constrained, but to the extent possible to support lives and livelihoods, preserve human capital and organizational capital as much as possible. But do what's feasible, I think, is the line on fiscal policy recommendations. Vaccines are extremely important. So the IMF has released different estimates of the return of investing in vaccines, and they are astronomical. So spending definitely needs to be reprioritized as necessary to make sure that the healthcare system is adequately resourced and that economies have, well, that countries have vaccines, access to vaccines in future. This is the highest return on investment. Now, everything needs to be anchored in a medium-term fiscal framework. This will help to alleviate debt sustainability concerns with supporting economies in the near term. There needs to be credible plans in the medium term to bring the deficit down if necessary. So medium-term fiscal frameworks are important. We talk about the importance of maintaining monetary policy support until the recovery is firmly underway. That seems a while away still in Africa. But of course, we have to watch what's happening with inflation. Countries like Turkey and Brazil and Russia already had to hike interest rates because they're facing inflationary pressures. And of course, monetary policy needs to be responsive to inflation as well. So this is what I can say on fiscal and monetary policy. Does Jan have anything to add?
Maybe I can add, like, on top of what you said. I mean, this is true for like many emerging market economies. In terms of fiscal policy, as you said, like priority is saving lives, but medium-term sustainability, I mean, should be accounted for. And in terms of monetary policy, especially for unconventional measures, which is found to be an effective tool, like even within the work in the IMF, like asset purchase programs and other unconventional tools, the scope, timing, and amounts should be clearly defined, and I mean there should be a clear communication in terms of the exit strategy as well. Especially, I mean, for example, asset purchase programs, like open-ended and large programs can raise other concerns such as fiscal dominance, and effectiveness of these unconventional measures can lower and also hurt central bank independence. In terms of central bank policies, reserve management is crucial. As I said, like new SDR allocation by the IMF would be important for many low-income countries compared to their GDP and existing reserve levels. So it's a source that can provide needed short-term liquidity for many countries. And in terms of, again, central bank, like transparency and clear communication would be very important, as also the chapter highlights. Thank you.
Thank you, Jan. Thank you, Galen. So unfortunately, we still have a few questions, but we won't have time to cover them all. I will send you the questions that we collected for your information but before we close, I would like to ask one final question, and this has to do with the results on the I guess on the Logit estimation on the likelihood of countries resort to asset purchase programs, right? And then you highlighted some elements, like if I'm not mistaken, if I recall correctly, related to the monetary policy regime of framework, I'd say, like a flexible exchange rate and inflation targeting, right? Central bank transparency, I suppose. And another fourth element I cannot recall right now. It has something to do with fiscal discipline,
fiscal rule,
exactly. And it seems to me that there is for all these elements, they are not completely orthogonal, right? So we presumably monetary policy frameworks based on inflation targeting, they tend to be more transparent. They tend to rely on more help from the fiscal stance in terms of fiscal sustainability, for example, fiscal rules, right? So less discretionary fiscal policy, I would say. They also tend to be associated with more flexible exchange rate regimes. So to what extent do you think that this also sends a message for central banks in the region, and then I would say policymakers in the region, in terms of their institutional framework regarding the relationship between monetary policy and fiscal policy, and how can help them, how that can buy some extra possibilities in terms of policy, right? Of using more non-conventional monetary policy, which it was not on the table for these economies, for example, during the global financial crisis or more recently even. Just a quick comment on that would be nice, and then we can close. Thank you.
Yeah, so these results indicate that institutions matter a lot. Having good communications by the central bank, having rules-based fiscal policy making and rules-based monetary policy making help. You mentioned these things are all highly correlated with each other, and those are methodological issues that we do cover in the chapter. We spend some time on that. So I want to reassure you that we looked at that very carefully, the methodological aspects of this, but certainly institutions matter a lot. Asset purchase programs seem to be part of the toolkit for many emerging markets going forward, but as Jan mentioned, there are several conditions around using them credibly, and communicating them is very important, to communicate them clearly so that people understand. For the fund, the advice has been that these really need to be initiated, asset purchase programs really need to be initiated by the central bank and not by the fiscal authority. And they need to be seen to be initiated by the central bank and not by the fiscal authority as well. So it's very important to maintain central bank independence when using asset purchase programs. Yeah, that's
very much. Thank you very much, Galen. Thank you very much, Jan, for your excellent presentations and for the good discussion. I would like to thank our participants today as well. Merci beaucoup à tout le monde. Obrigado a todos os participantes. I would like to reiterate that we in ATI, our intention is to keep organizing these events with interesting and relevant and timely policy discussions for the region. I would like to thank all the participants for their interest, and Galen and Jan for their brilliant presentations. I would also like to thank my colleagues who helped organize this event. Kirvi Armogdoon and Anna. This is much appreciated, and I hope that we can meet again in the future. I would also like to thank our colleagues, the interpreters, French interpreters and Portuguese interpreters, that allowed us to reach a wider audience from all over Africa today. So thank you all, and I hope to see you again in the future. Thanks.
Thank you very much.
Bye.